Hello, welcome back to the continuing lecture in investment analysis. As we continue with the Fama French three-factor model, uh, one of the first, one of the second factor was uh, basically uh, the go back to the small form premium, right? Of course, the first factor is the market, right? The third factor is the uh, high book value to market value, market price uh, premium, right? And usually mature firms um, mature firms would have relatively lower market value relative to the book value. Because, first of all, mature firms are large firms, and large firms or mature firms generally have lower growth rate, but they are cash cow because they have mature firms means that they have been around for a long time, and they are at you know they have pretty much their saturated market share. I mean, it doesn't have to be necessarily duopoly example like Pepsi and Coke, but suppose even for you know the market for bottled water. I mean, how many uh, major players are there in uh, the market for bottled water? Not that many, only about three, right? We all know, Poland Spring, Dasani and Aquafina, and we all know Aquafina is Pepsi, Dasani is Coke. Poland Spring is actually owned by Nestle. Anyway, these three companies are basically industry giants in the beverage industry, or not just beverage, but also in food industry in general. You know, Pepsi and Nestle are also in the snacks, not only the beverage, right? Frito-Lay is Pepsi, if you know, because of their and think about it. Although there are smaller companies, smaller local or regional companies like Deer Park or whatever smaller brands, they are uh, uh, they are generally regional, right? Not like international global giants like Pepsi, Coke, and Nestle. Now, so obviously because they are mature, their growth potentials are uh, lower because of their market share is at the highest level. I mean, uh, in terms of beverage, soft drink market, all these three companies, Nestle, Pepsi, and Coke, are all divvying up the entire market, right? Entire, uh, not only geographic, also demographic, uh, and also global. Not only some national market, but global global market. So the mature firms have a lot of them have a lot of them are in financial distress. Why? Large companies generally have higher leverage ratio, right? Why? Well, basically, the size of the company is already a collateral, right? It gives them a lot of ability to borrow, right? Uh, and especially if it is manufacturing, right? They have plant and equipment. Plant and equipment, I've been telling you over and over, plant and equipment are very good collateral. They are self-collateral. So they have a higher uh, ability to borrow, so their capital structure are more likely to be highly leveraged, and then they are in more likely to be in financial distress. Uh, and then uh, so that depresses the market value, relative book value, and it derives a large share of market value from assets already in place. Um, so they are relatively value stocks. In other words, for their book value, right, market value is lower, right? So they are relatively, you buy them, relatively uh, for cheap. So that's value stock. Now, low book to market value group are uh, uh, viewed as growth firms because for book value, market value is more, elevated, right? So market value derives from anticipated future cash flow uh, rather than assets already in place. Uh, if What does that mean? That means their value comes mostly from growth potential, right? So there exists considerable evidence value stocks trade at prices less than growth stocks, and therefore higher average return on rate of return, right? Higher average rate of return because you buy cheap uh, for the return, right? At a lower price. So high uh, high book to market value ratio minus low book to market price ratio is called value premium. Now here's a puzzle. The puzzle is the high book to market price ratio reflects maturity. And if it reflects maturity, its future cash flow is more predictable. And ceteris paribus, all other things being equal, required return for growth stocks should be less than required return for mature value firms. That is a little, even though I wrote this, that is a little, um, the required return for growth stocks should be greater than, right? Because you don't have to discount it. Um, but there's one explanation mature firms with large amounts of installed capital confront higher adjustments, higher adjustment cost in adapting to shocks in product markets. Hmm. Okay, okay, that that explains it. But then let me just make sure what. considerable evidence, while value, appropriate comments. Now this part, growth firms, I mean, mature firms requiring higher, greater required return. I mean, logically, this cannot be the result of the conclusion of this preposition, right? In other words, because its future cash flow is more predictable, and this preposition cannot lead to this type of conclusion. I mean, it should rather lead to the opposite conclusion, right? I mean, in terms of logic. Logically, right? But the fact, but this, if it is, I would rather put it this way: despite the fact that cash flow from mature firms are more predictable, right? Despite the fact, still the required return for mature companies are greater than required return for growth stocks. And why? And one explanation is that the mature firms with large amounts of installed capital, physical capital, confront higher adjustment costs in adapting to shocks in the product market. Then it makes sense, because suppose Apple has invested a lot in developing special chip, right? Or display display, a panel, LED, or I don't know the technological term for that, but AMOLED or something like that, right? And suddenly, so they invested a lot into manufacturing these, display and the memory chip to process high quality graphics, and suddenly the market trend is suddenly there's a new technology, a better technology that can handle that can produce high resolution, high quality graphics at a fraction of cost, with without with minimal adjustment to the existing production facility. Then this would be which would be a totally different technology than what Apple has developed. Then what's going to happen? Apple should make adjustment to their products, right, to their components, and this will this turns all their investment into this uh, manufacturing equipment. Uh, it turns it all into a waste, right? And then to make adjustment to the new uh, paradigm in the market, then it will cost them a lot, right? I mean, if this is the scenario, then it makes perfect sense, right? Despite it's Apple's more mature company's more predictable future cash. Now, S&P 500 and broad market index, including 4,000 stocks, like Russell 2,000, 4,000. There's a broader market index. Um, tracks Google's returns better, right? With broader market index, right? Google's the model tracks the Google's returns better. So three-factor model is a better specification, and it's reflected in three aspects of the successful specification because they have achieved higher adjusted R square and lower standard errors, and lower error variance and smaller uh, alpha. So makes a broader market index the choice of the Pharma French model, uh, first line empirical model, and index choice, and Pharma French model is the first line empirical model. So some data to test this model. They've collected data and monthly rate of return between January 2006 and December 2010. So monthly excess return and total return, right? Of course, T-bill, is risk-free rate, so there's no obviously there's no excess return, right? There's no standard deviation. Market index excess return on the market index is this. Standard deviation of the market index is like this. Small business premium, right? The small business premium index has excess return of 0.34% and a standard deviation of 2.46 and a high high to low market, high market, high book to market price, high minus low, high book price to book value to market price ratio premium, 0.01 excess return, right? Google's got 0.94 excess return. These are the standard deviations. These are arithmetic averages, and geometric averages are like this. The cumulative returns are like this. Cumulative over 5-year period, right? Oh, we got 43. That was, also we saw this previously, right? I mean, this is the same. The data that we used before. So our market index includes all New York Stock Exchange, NASDAQ, and Amex stocks. So quite extensive. It's almost pretty much everything in the market. Now the result. Before the result, how the testing was conducted. So market beta estimate was 1.51, which was much higher than the single factor models, because in single factor models it was 1.2 or 1.16. Also, it reflects the high cyclicality, right? Cyclicality. Obviously, the greater positive and greater the number, right? The beta, high, more, cyclical, right? The stock is more cyclical. So let's see. Give me a second. I'm going to have to. Okay. Actually, no, I have to take care of attendance issues. I'm afraid I have to be multitasking at the moment because I have to take care of the attendance of some class that is currently. Okay. And alrighty, so and significantly greater than 1 by a standard deviation of standard error of 2.43. So our standard deviation was, see, 5.544. That was the standard deviation of the market index. And if we go back to a single factor model, our single factor model gave us the standard deviation of that was not it. During that period, right? I'll have to look it up, but there was no summary statistics of that. So I'll have to check this data, but it looks like Well, I'll check that. I'll check that number later. But just uh, we'll take it that that means it is. Uh, that's the standard error of the uh, new market beta estimate, and the small farm premium has the beta of negative zero point 0.2, yet not significantly uh, different from zero at uh, the standard error of 0.44. Okay, so it's more like well, it's like t-value. I mean, I thought it was uh, 1.51 with the if you divide that 1.51 by this t-value, I mean this standard error, still that doesn't seem to add up. But this one is at least it just says it's not significantly different from zero because t-value would be uh, very small, right? Uh, Google exhibits negative and significant uh, book to market value beta of negative 1.33 and with a standard error of 0.37. So this one would have a significant t-value, right? Still growth stock. This means Google is, but that was already 2006 through 2010 period, and Google was still a growth stock, right? Meaning think about it. High book to market value means it's a high book to market value means it's a mature company, right? But this and the beta is even negative, right? Not just small, it's negative, right? Then that is a clear counter evidence that uh, Google is not a mature company. In 2006, actually, Google went public in 2000. Google went public in 2006, if I remember correctly. So at that point, and Facebook went public in like 2010 or 2012. So I believe 2010. So in 2006, Google was still a new company, right? A growth firm, right? Um, the forecast of the future returns for uh, small company premium, right? Um, if you add 2.5% for small company premium and 4% for uh, uh, you know um, uh, so small pie, small This was actually high minus low, right? High minus low. Um, yeah. Uh, uh, so small business premium at, for small business premium, 2.5% and 4% for high market. Uh, and this is high minus low, book to market value ratio, right? Add those premiums to T-bill, right? And T-bill, which was 2.75, and market risk premium of 5.5. Um, and it becomes more difficult to apply because single factor may be, and therefore single factor may be preferred if less successful in explaining, even if it is less successful in explaining past returns. Now, this part, because the explanation of these data values, right? There is not sufficient explanation where these data values came from. I think I will have to explain this um, because when I made this slide, it was all in my mind, so I could just truncate everything. But when I look back into it, all the truncated part is not coming back. So I will have to get back to the data source, and actually see where how the data values, those data values came about. So it will take another um, a session to analyze these data values. So I will, and it's been like more than 30 minutes already. So I think I will have to stop recording here, uh, and the multitasking that I'm currently preoccupied with. I'm sorry. Because of that multitasking, I cannot clear up my thoughts. There's too many things on my mind at the time. So I will see you in the next video, and get back with the data source. Okay, and stop recording here.